All right, guys, happy Monday. We have a lot to talk about today, so we will dive right in. Um,
Tyler,
I want to ask you, do you want the good news first or the bad news?
there's good news.
And I already know what I'm gonna do, but I'm just curious to see. So we want good
Always
news
give
or
us the
bad
bad
news?
news.
There we go, bad
Bad
news.
news first.
All right, so I'm gonna share my screen. So I only have like one bit of bad news today. Um, All right, so I'm gonna kind of go back and forth from sharing my screen to not. So, okay, so here's the bad news. All right, all of the good stuff that we're going to share today that is potentially very positive for the real estate market, home ownership, affordability, all of the above. All of that good news is in the face of pretty significant headwind, and the significant headwind is the government's spending problem. The maxed out credit card interest that continues to accumulate. And so if you've been on these calls with us for a while, we talked a lot earlier this year, especially that um, government debt, government spending, running big deficits, the interest expense on the national debt, um, all of those are inflationary. And so if you think about what happened last week, where the president announced that he is taking $200 billion of Fannie Mae's profits and buying mortgage bonds. Okay. And so think supply and demand. When more demand comes into the market, okay, which is 200 billions of dollars, the price increases, right? More demand, price increases. When the price of a mortgage bond increases, the yield or the rates go down. And we'll talk about that more here in a minute. But that's what happened at the end of last week. The government US Treasury market is kind of the opposite. We have demand, yes, people all over the world, individuals, institutions, foreign countries are buying US debt, US Treasury debt, but the amount of supply is incredible. And if supply floods the market, like what would happen? I'm in Orlando. What would happen if 25,000 houses in Orlando hit the market tomorrow?
Let me get some.
Prices would crash, right? Supply and demand. And so 1.4 trillion with a T dollars of government debt. That's our deficit currently. And that's what we're spending in interest each year. We're flooding the market with supply of treasuries because of our deficit. That drives treasury prices down and yields up. So all the good news we have is still flying into a really strong headwind of government spending. Um, so all of the things President Trump has proposed as potential solutions to affordability, driving interest rates down, helping the housing market, that all can be beneficial, but we still have a pretty big headwind, which is government spending, government debt, and we're at $1.4 trillion annualized just in interest alone. Before too long, we're going to spend more on interest than we do anything else. What are the two other big spending items? Kind of Social Security slash Medicare and
Military.
military, right? And so it's like the military, Social Security, Medicare, and interest. Okay. One of those three doesn't benefit us a whole lot. Um, so one of the three secures us, one of the three supports us, especially at later stages in life, and one of the three brings us down. And that bringing us down, and so there's only so much room for interest rates to go down because of that supply. And I think that's an issue that's going to continue. And it seems like in Washington, no matter, if you bleed blue or bleed red, there's not a whole lot of solutions to that problem. It is getting a little bit better. So some of the tariffs have brought some revenue in. Our trade imbalance is a lot better than it was. But, we're talking like baby steps, climbing a mountain. Okay, so that's the bad news. So we'll get that out of the way. Okay, so let's talk about um, the good news, and some of what the president has proposed recently doesn't really affect things. I'm not sure what we're all going to do when Trump's not in office because, what will we do Sunday afternoons other than like wait for a tweet and a policy, idea to come out, it'd be interesting to have the power to tweet on a Sunday and have the markets have a major reaction. Um, and no more 160 tweets a day. That's right, Andy. So let's talk about some of the proposals that were floated last week. So
Know
if we
about
go
you
back,
guys, but I'm finding like a lot of this stuff kind of very anti-Trump. And, there's been a lot of fraud that's been disclosed in the last few weeks. And you didn't talk about how that's going to save us money when we get a handle on that. And that's coming. So, like, let's be a little balanced here. If I'm correct, I'm seeing a little bias.
oh, Trump, Gail, I'm a big Trump fan personally. So I voted for Trump a couple different times.
Okay.
So yeah,
Okay.
if you're just joining us, like if those of you guys that have been on this for a while, like I think it's important for all of us to take our I'm a Trump person or I was a Biden person hat off when we're talking real estate. And because I think a lot of times our customers want an opinion that like might not be what we politically agree with.
I
So,
agree.
but I appreciate. I'm glad you mentioned that because if you guys felt that way, I certainly am not trying to be anti-Trump, but I'm just trying to be more what he's doing that could be good, what he's
Got it.
proposed that doesn't have an impact.
Got it.
And
Thank you.
because I like him, I like to we can joke about him and not feel like I'm bashing the guy. But so let's talk about some of the proposals. So the proposal of capping credit card interest rates. Okay. Um, so does that sound like a great idea? It does, right? Like lots of our customers are burdened by excessive credit card interest rates, kind of like, student loan relief that was proposed in the last administration. I'm not sure if the president has the power to just unilaterally, cap credit card interest rates at 10%. And I'm not sure if the credit card companies, how they would react. So I don't know if that has a lot of legs or if that's an idea. I think a lot of what the president's done over the past few months is float ideas to see what the public likes. And then, based upon what the public seems to have an appetite for or what the market positively reacts to, then push forward with that. Like if you guys remember a few months ago, Bill Pulte, who's the chair of the Federal Housing FHFA, talked about 50-year mortgages. The market didn't react to it. Has anybody heard talk about 50-year mortgages recently here? Right, not a whole lot. Okay. We also have to remember that we're in an election season, and we talked about that a bunch on these calls. And during an election season, a lot of the things that get proposed are, they're politicians still, right? They want to get reelected. And so what plays good in an election season? If Trump isn't reelected, I'm sorry, if the Republicans lose the House and or Senate this November, what do you think the Democrats are going to do to Trump? They are going to go after him like crazy. There's probably going to be talk of impeachment and all kinds of stuff and lawsuits and investigations. And, so I think the president's proposing a lot of things right now to try to keep his party in power for his last 2 years in office. So the credit card thing, I think, does it sound like a good idea? Yes. I'm not sure if there's a lot of legs behind that. It doesn't really have a big impact on the real estate market at all. So, something for us to watch, but is it a really something that's going to move the needle? Probably not. Um, there's lots of talk of institutional purchases of real estate. And I think this is actually a really good chart to share. I'm going to share my screen here. So this to me is very market specific. Okay. So the chart I'm sharing with you guys here is nationwide numbers. And you can see the percentage of purchases by larger institutions. They define that as landlords with 100 plus properties. And so you think your hedge funds and private equity. So that surged during COVID, and then it's shrank, and it's been 2 to 3%. Like I think 2 to 3% of all homes are owned by an institution. Those are the statistics that I've seen recently. Um, Eliminating the ability for institutions to buy properties. Again, can the president do that? Maybe, maybe not. Does it move the needle? I'm not sure if it moves the needle a lot. I think in certain markets, like where I'm at in Orlando, we got really heavy during COVID of institutional purchasing of real estate. Now they're starting to sell. Like we have a closing today with a client who is buying a house from a private equity kind of hedge fund, institution. I think they've done a good job of not flooding the market with supply and selling everything at once. But again, if that proposal gets passed, is it going to move the needle? I don't think it's going to move the needle a ton. Um, The big news over the weekend, and I'll talk about the MBS purchases on Friday last, but the big news over the weekend was it seems like Trump and Powell are kind of butting heads again. A lot of that was done in the public sector, in the media, tweets, interviews, comments, things like that. There must be something stirring behind the scenes because there's a Department of Justice investigation against Chairman Powell right now. It's kind of what I read over the weekend. Not sure the exact details. It has to do with some testimony last summer. I don't think that's anything more than Trump and Powell are butting heads, right? And Trump wants Powell to be more aggressive, to be more dovish, to cut rates more. Powell has been a little bit more reluctant to do that. And so we've talked about this on a bunch of calls recently here that I think Trump is probably going to announce the successor to Chairman Powell. I think it's imminent. And once a successor is announced, even though Jerome Powell will still be Fed chair in name, through May, in reality, whoever the successor is will basically hold all the power because what the Fed does will become less important than what the successor says. I think we're probably going to get a dovish Fed chair. I think the two or three people that are floated that are most likely to be given that position are more dovish, which means less likely to fight inflation and keep rates high and more likely to cut rates. That could be really positive for the real estate market that could continue to bring rates down as long as it doesn't cause inflation to spike. And I think why Jerome Powell is reluctant to cut rates, and I think he's done cutting rates through his term. Like, I don't think he's going to cut again unless he's forced to, while he's still in office. He's reluctant to cut because he cut, and if you guys remember in 2024 in the fall, they cut 100 basis points, a full cut, three different cuts, 1 point total. Inflation spiked in the fall of 2024 and mortgage rates jumped up. So I think that's why Powell is reluctant to cut. But that'll be really big news. And it seems like Trump and Powell are kind of butting heads right now. So it'll be interesting to see, does that push Trump to announce the next Fed chair a little bit faster? I think that's a possibility. Okay, so the big news last week, and I'm going to share my screen again, is the president, and I kind of thought something like this would happen. It was definitely not what I surprised, but I thought that we might get another round of QE or quantitative easing with the new Fed chair. And QE is basically where the Fed uses its capital or creates capital to buy mortgage and treasury bonds. They bring a lot of demand into the market that drives interest rates down. I thought that the president was a little bit kind of purse strung, that if Chairman Powell at the Fed wasn't willing to do that, could they implement some type of QE to try to push interest rates down? And they really couldn't without the Fed. But what happened on Friday, Fannie Mae and Freddie Mac, which have made record profits for the past 15 years, kind of post 2008 financial crisis when the government took them back over, the president's taking $200 billion of their profits and using that to buy mortgage bonds. Really, actually, kind of a brilliant move, in my opinion. Doesn't have to wait for the Fed to do it. It's money that's already there. It's money that wasn't created in thin air by the Fed or by printing of money. It was cash profits they were sitting on. They're using that to buy mortgage bonds. Buying mortgage bonds will drive down interest rates. And that's what we saw happen on Friday afternoon. When Trump posted that, the market immediately reacted. And a lot of times, and we talk about this pretty frequently, the news is what moves the needle, not the actual action. So did Fannie Mae take its cash on Friday and buy $200 billion of mortgage bonds? No, that tweet was like Friday or Friday afternoon. The announcement of the policy is what moved the market, and the market moved and rallied, and mortgage rates came down on that news. I think that'll be very similar to Venezuela. And we talked last week that the U.S. involvement in Venezuela should bring oil prices down. Oil prices coming down brings inflation down. That brings interest rates down. But we also talked last week that the market moved on the news of potential increased production in Venezuela, which should bring rates down. Now we need to see that production improve. And so the announcement last week of buying mortgage bonds is very similar. The market came down, rates improved on the news. Now we have to see it followed through with actually taking that cash and buying mortgage bonds. But big picture, there's two or three things that have been really working in our favor the past few weeks. The chart here I'm showing you, and this is a great social media piece to share with your customers. Interest rates are at a 3-year low. This is a really good visual. The chart that I often share, and I'll pull it up here, is mortgage bonds. And the mortgage bond chart is a little bit more confusing and a little bit harder to follow because this is the price of a mortgage bond, not the interest rate on a mortgage. And so it's inverted. Like when I show you guys this chart, we want the price of mortgage bonds to go up. Like we've seen a really good rally since May of this year. That's hard to show customers because it's flip-flopped, it's inverted, and they look at this like, well, it looks to me like rates are going up. So this chart here, and again, get with whoever you work with on our team here at Cross Country. We'll get you guys these charts. I think this is a great Instagram, use the green screen feature, put it in behind you, and do a video this week. I think it's a great call to action to customers. So to me, this is really powerful and probably the best news to share, which is whether that's policy changes or geopolitical things or the jobs report last week was weak. We've got some good inflation numbers. All of that kind of snowball effect has caused rates to hit a 3-year low. I shared the other day this chart, and I'm going to jump back in here and show you the MBS chart. And so we talked about these black lines are called ceilings of resistance. And we talked about at some point, there's going to be news that causes rates to bust through those lines, which would be a signal of a nice rally. And you can see that rates traded up to this a couple times earlier this year. And I said last Monday, and if you remember, we use that rubber band analogy, like the longer rates stay in a close range, that rubber band is going to stretch, stretch, stretch. And when it pops, rates are going to move quickly up or down. We don't know what's going to cause that to happen. Well, we got that news last Thursday or Friday with Trump announcing the MBS purchases. And so the bond market pushed through that ceiling of resistance. That's why you saw rates take a meaningful move lower. And that's why you're hearing everyone talk about rates at 3-year lows. There's another ceiling of resistance that's a little bit higher, another 25 basis points or so higher that we have to get through. And if we go back to like early 2023, that's kind of where we're at. And when people say rates are at the best level in 3 years, January of 2023 was the last time bond pricing is where it is today. To have bond pricing meaningfully better, meaning rates meaningfully lower, it was the summer of 2022, June, July, and August. Does anybody remember what the summer of 2022 market was like from a real estate standpoint? Okay. Was it a seller's market or a buyer's market? Does anybody remember? Okay, I've got a seller's
Seller.
market. Okay. It was actually, for me, one of the least enjoyable, most stressful markets I've been in my 23 and a half years. In Orlando, it was multiple offers, 15, 20, 25 offers on a property, absolute chaos, like craziness. I guess if you're a listing agent, it could have been good, but I remember a lot of listing agents back then. It was like, no, it's not fun. I don't want 20 offers. Like, I'll take 3. I could negotiate 3 people to move the price higher. 20, it means you're going to have 19 people mad at you. And so, why was the market so hot back then? Interest rates hadn't spiked, right? They were still historically lower, and there was a lack of inventory. And so if you look at nationwide numbers, inventory the last month or two has come down. If interest rates come down, buyers re-enter the market. We've been saying this all fourth quarter. The market this year could shift really quickly from a seller's market, and maybe not from buyer's market, like which I think it is currently and has been, probably not to a seller's market, but certainly things shift more in the seller's favor. So I think it's important to take a chart like this and share with buyers, like ask them the question, hey, Mr. Buyer, with rates coming down like this, what do you think is going to happen in the market? And they'll come to the conclusion themselves, which is good for them, good for affordability. It'll increase competition. It'll probably increase multiple offers, and it'll probably push prices a little bit higher. And we've been saying for most of the second half of last year that I feel like Q1 of this year, like where we are right now today, is probably the sweet spot for buyers. And at some point over the next few months, if this trend of rates moving lower continues, it's going to become a more robust market, and things will start to shift in favor of sellers. So I think this is very powerful for us to share, both the good news and also that it also means don't wait too long. I think there's going to be people that will get greedy and they'll say, well, I look at this chart, I see rates have gone from 7 to 6. Why don't I wait for them to go to 5? Are rates going to 5? I say no. And I say no because of that first chart I showed you guys, which is the 1.4 trillion of interest expense. I don't think rates are going to 5. I feel like that headwind is too strong. If we go from 6% and we get into the 5.5 to 5.7 range, I think that's probably about as good as rates are going to get this year. There's just too much headwind with the government debt that's continued to accumulate and accumulate and accumulate. I just think it's going to be a really difficult battle to get any lower than that. Absent some type of crazy, Federal Reserve, QE, interest rate, artificial moving lower, which happened during COVID. I don't think they'll have to do it this year. I think getting into the 5s will probably improve the market enough. Okay, the last chart I've got, and this is something that is a really positive sign. So this is the spread between the 10-year treasury and mortgage-backed securities or 30-year fixed rate mortgages. And if you remember back like in 2022 and 3 when rates spiked 7.5%, 8%, they spiked because of inflation. They also spiked because that spread between the 10-year treasury and 30-year fixed rate mortgages reached a significantly high level that was very high historically speaking, 2.5%, 3%. So if the 10-year treasury was 5, 3% above that, mortgage rates were 8. That was kind of the real number when we peaked, like summer, late 2023. Right now, that spread has shrunk. The gap between the 10-year treasury and 30-year fixed rate mortgages is closer to 2%. Historically, 1.6 to 1.8 is kind of the number. And so if rates have gone down around 6, the spread of the 10-year treasury and mortgage-backed securities shrinking and a little bit of a dip in the 10-year, that gets you into the 5.6, 5.7 range. And so the people that we trust the most, that we follow the most, Barry Habib, NBS Highway, are kind of projecting and calling for rates to bottom out this year, somewhere like in the 5.6, 5.7, 5.5, somewhere in that ballpark. But again, not a whole lot better than that. Okay, we talked about mortgage-backed securities pricing. We do have a Fed meeting coming up. It's later this month, January 28th. There is a 95% chance the Fed doesn't cut. I think you can almost make that 100. The Fed's not going to do anything this month. But March, April, the next couple meetings, you might hear some talk of a Fed rate cut. I don't think that'll happen in March. I think the earliest you might get a Fed cut would be in April, which would be the very end of Fed Chair Powell's term. And I think that would potentially happen if he was basically like, the votes were kind of diminished his opinion, and the new administration, the new Fed chair, basically push for rates to go lower. So nothing's going to happen in January, maybe in March. Right now, they're 75% chance of no cut. In April, you might get a Fed rate cut. It's interesting that we're talking about all these kind of political policies, and we're not talking about the jobs report. Usually today, we spend half the call on the jobs report. We got a jobs report last Friday. That would have typically been a market mover, absent, right, Trump's policy on mortgage-backed securities pricing. So the jobs report has been diminished a little bit, and partly diminished too because they've been very inaccurate for the past 12 to 24, 36 months. I think the market's reacting less to the jobs reports, but that trend has been weaker, and that's been a common theme we've talked about on these calls. This week, we do have a big economic report. We have the Consumer Price Index that's going to be released tomorrow for December. Important inflation measure. We need that to come in good for 2 reasons. Okay, one, if the CPI that's released tomorrow, 8:30 in the morning, if that comes in positive and it shows inflation is moderate, 2.5, 2.6, 2.7 range, that'll keep last week's rally, if not moving, forward as far as rates moving lower, at least it'll keep things stable. A hot inflation reading tomorrow, you could see a little bit of a tick up in rates. So we want a good inflation reading tomorrow. The other reason why it's important to get a good inflation reading tomorrow is in December, we had a really, really tame inflation reading for October and November that was released last month. So the last reading of this consumer price index. But that was readings that were taken during the government shutdown. And so the market isn't totally trusting those readings. So if we get another positive inflation report this week to back up the positive that we got last month, that's going to be really good news for interest rates as well. So that said, all of these economic reports will take a backseat to changes at the Fed, policy changes, what happens with this mortgage-backed securities purchasing program. But overall, we're, and I think a really good spot, a really positive spot with rates, likely drifting lower. There was a bunch of questions in here. I just want to see if I can cover a couple of these. Wilton, you said the difference between the blue, gray, and gold, was that on one of the charts?
Yeah, it was the mortgage rate, the average interest rate US 30-year mortgage.
All right, let me pull it up here and see. I think that was the average rate reported by like Fannie Mae has an average rate they post, like different news publications have rates they post. Like there's not an official average, rate. It's done based on polling. So I think you had the Freddie Mac poll and the NBA's poll, and I'm not sure what the third line would have been, maybe NAR or something like that.
Okay.
Okay, cool. I think I've got most of the questions. I think I answered Allegra's. Okay, so couple things just to put a bow around this. I'm going to share my screen and just offer if anybody wants a copy of this, let us know. So I'd mentioned Barry Habib as a name there. So he owns a service that all of us followed him for 20 plus years. He's the smartest guy that I know when it comes to forecasting the mortgage market, the bond market, the real estate market, just kind of how everything ties together economically. He hosted that we all were on a 2026 market forecast, and I can probably get a copy of a recording if you guys would like that. But I have his slides, and so if anybody would like a copy of these slides, let us know. But this is all of his projections, what he thinks home prices will do, inflation, unemployment, really good data. Everybody in our team has access to this. So if you guys would like a copy, just message us and we'll get this in your hands. Some of these things are things we'll cover on future calls, but again, just didn't have enough time today to go through this whole presentation. But if anybody would like a copy of it, message us and we'll get it in your hands. Okay, guys, with that, we'll let you jump off. Have a great day. Have a great week. We will see you guys next Monday and talk to you then. Thanks, everybody.